Hello and welcome to Bondcast, a podcast series where we discuss the latest themes and events shaping rates markets. I'm Ian Vanderhorn, a US-based macro strategist, and I'm joined here today by our global market specialists Paul Robson and Oriane Parmentier. Paul, let's start with you. As usual, there was a lot of data in the UK this week. Why don't you just run us through that and maybe how it impacts your views on the Bank of England as well?
Yeah, happy to start there. Just for good order, we're recording this week's Bondcast ahead of the release of retail sales numbers and government borrowing numbers. Those borrowing numbers could be important ahead of the spring statement, but given the budget was only a couple of months ago, it came a little bit later in the year than normal. I'm not sure they'll move the needle significantly, but January is an important month for self-assessment payments, and so a surplus month. So it'll be important to look at those numbers when they do get released after the recording. Retail sales as well, just a gauge of consumer confidence here in the UK, but again can be really quite volatile about the different timings of various events like Christmas or Mothering Sunday, for example, and Easter. So again, be important information. But the two big releases this week were labour market numbers and inflation, both central to the Bank of England monetary policy outlook. The UK doesn't have a dual mandate. It is about price stability, but whether inflation falls sustainably back to target is going to be a function of how the labour market is performing, and particularly wage formation in the UK, and whether there's been a structural break or we've just had a second sort of peak in inflation that's just working its way through the system. And certainly the focus this week for UK assets was very much on the data and pricing for the Bank of England, most obviously at the March MPC, but equally where terminal rates might be in the UK by the time we get to the end of the year, and far less focus on politics. The initial reaction to the labour market data we thought was quite surprising. There was a dovish interpretation of the report overall. It feels like markets were concentrating particularly on the headline average earnings number, year-on-year growth, which came in noticeably below expectations, just over 4% year-on-year, 4.2. Market and our economists were expecting something that would be around 4.6%, pretty much unchanged on the month. That's obviously a big miss, but because it's the headline number, it includes bonus payments, and they can be really quite volatile, and the timing of those can be different year to year. And so once you strip out those distortions from bonuses, underlying wage growth was pretty much in line with expectations, but markets were more focused on that headline number. And I think that plays to the idea that a lot of market participants do believe the terminal rate in the UK will ultimately be lower than is currently priced. I know that's a little bit odd because market participants determine that front end pricing, but when we talk to various market participants, we get the sense that there's always a feeling that rates will come down at some point more quickly. In terms of the MPC, we just think that they'll look through this distortions from bonuses, and next month's numbers should show that wage growth, we think, has been a little bit, will bounce back. And also the other components of the labour market report, employment. This is something that the Monetary Policy Committee was focused on at the January meeting, that was 5-4 vote in favour of unchanged rates, which was a more dovish outcome than markets had anticipated. And in terms of payrolls, the latest month number was better than expected, just a fall of 10,000. But there were also upward revisions to prior months. The prior month's numbers showed a 40,000 drop in employment, and if that was to be replicated through the year, then that would be important. But it was actually revised pretty much to flat. And the MPC have noted the deterioration in the labour market and has also focused on their own agents' reports around the country, but certainly the data don't support that. There was a little bit more focus on the continued rise actually, in the unemployment rate. But again, these numbers are based on the labour force survey, and there's still quite a lot of uncertainty about how valid these numbers are. When you take the headline average earnings numbers adjusted for bonuses and payroll, we think that the market's too dovishly priced. We also got some inflation numbers this week. I won't go into too much detail. Core inflation was broadly as expected, and service sector inflation was still shown to be 4.4% on a year-on-year basis. This is a proxy for domestically driven inflation. And if you have an inflation target of 2%, then it's still very uncomfortably high. So when we take all that together, we think that the Bank of England will deliver the next rate cut in April, not as priced by markets at the March meeting. And that ultimately will be the last cut from the Bank of England this cycle. Markets seem to be more confident that the easing cycle ends at 3.25%.
Thanks, Paul. A lot of parallels that I can draw there to the US, particularly with respect to some of that strong underlying wage growth that you mentioned. But I'll perhaps come to that in the US section. Briefly, though, you did mention politics at the beginning. I know that's been in focus over the last couple weeks. Is there any, update there? I understand there's definitely separation in the UK between the government and the sovereign, but on the government side, is there any update for our listeners?
Yeah, in terms of politics, the risks we think, have subsided, or certainly the focus on politics has subsided somewhat. They dissipated almost as quickly as they escalated after there were sort of reassuring comments out of the cabinet, for example, in terms of stability in leadership here in the UK. There are still a couple of identifiable risk events in the coming months that might be a lightning rod for volatility, certainly in gilt markets and the currency. One is a by-election at the end of the month, and the other is the local elections that will take place on May 10th. And again, that might be an opportunity for political risk to rise again. The reason that this plays importantly for the gilt market is I think market participants, certainly in the past, given correlations, feel like a leadership change would lead to a dilution of fiscal policy here in the UK and ultimately more borrowing and higher yields, higher inflation premium, a higher term premium as well. And even this week, there was a couple of indications about how there's still a lot of pressure in terms of fiscal policy. This week, it was about defence spending. And of course, you can tweak the fiscal rules to take into account increased defence spending, but ultimately, it's still issuance into the market. And in a world where there is already a glut of issuance, that could be important as well.
Just one question from me as somebody who's less familiar with the UK political system. What is the specific significance of those local elections coming up? Are they seen as somewhat of a litmus test for the Labour Party and a Starmer government that's been under a little bit of pressure? Is that how I should be thinking about those locals?
Yeah, I think that's the right way to think about it. The other way is just to look at the opinion polls for an indication of potential political stress at some point. But it will be interesting to see how the government gets on in those by-election and the local elections. Governments tend not to do so well in sort of by-elections and local elections while they're actually in government, and by the time you get to an election, quite often things have reversed. I think it's just seen to be whether it increases pressure on the leadership if the performance isn't as they had expected. But as you say, very much a litmus test of sentiment towards the current government.
That makes a lot of sense. Makes me think of the midterm elections here in the U.S., which are, of course, coming up later this year. How about any new themes, maybe anything we haven't covered with respect to gilts? Anything that we should have on the radar?
I think that the outlook still remains very much one of supply. I think actually this week it was more cross-market. Certainly what stood out to me was the fall in 10-year treasury yields, which one of the points we've been making over the last sort of year is that the marginal buyer of gilts is increasingly overseas investors, and they're price sensitive, and so gilts might become more sensitive to some of these cross currents in global markets, and certainly gilts actually perform relatively well in absolute terms and also cross market. We do have a spring statement coming up at the beginning of March. We don't think that will be a big market mover. The focus will probably be more not on policy changes and borrowing expectations, but the remit for 2026, 2027. But I think that's a well understood story that the UK continues to issue shorter. WAM of issuance is now much more in line with what it is in the States and in the rest of Europe. Really, I think over coming months, it will be about market pricing for the Bank of England. If we price a higher terminal rate than currently shown in markets and we get a little bit of political risk, then we think ultimately we'll see 10-year yields up around 480 sometime in mid-year, maybe Q3 this year.
Excellent. So forecasts maintained. Oriane, let's switch over to you. I know it's definitely been quieter in the Euro area, but I guess one of the interesting dynamics in EGBs has been the continuous support we've seen for French bonds specifically. What's going on there?
Yeah, I mean, clearly French government bonds have been, very resilient. I think, in a context also where country spreads in general have been tightening across the board against Germany since the start of the year. But perhaps an interesting moment to touch on our French views, I think, since we have the local election coming in just 1 month. So as I was saying, demand for French bonds have, stayed strong. 10-year 080 spreads have tightened to close to 55 basis points over bonds, and this is levels we hadn't seen since the first half of 2024. I think the key point perhaps here is that there is no obvious catalyst in my view, for a meaningful widening in the near term, at least not based on French politics. Markets are in a clear carry mode. Volatility is low and buyers are stepping into, I think, to buy on any dip, it seems. One dynamic I like to point out with regard to France is that the fiscal situation or any fiscal developments in France have not really been a driver for 080 price action, I would say, in recent months. I think investors have been much more focused on politics and on budget deficits, for instance, and I think part of it here is context. Arguably, France doesn't look like a fiscal outlier if you look at some of its European peers and even beyond Europe. And its economy has been also more resilient than Germany's, for instance, last year. So politics have been the primary driver of French spreads, and there is not much that concerns us in the short term, really. I was mentioning the local elections. They are coming up mid-March. Historically, they haven't been really seen as a great predictor of presidential outcomes. They tend to reflect local dynamics more than national one, I would say. And I think here, even if the far-right party, so the National Rally, comes well at the local election, I think that simply confirms where national polls already are. So I would imagine the market reaction would, stay fairly limited. If anything, looking at the recent news flows in France, I would say it has reduced the likelihood of a far left surge, which I think would have been, the least market friendly result. I think looking ahead, September is perhaps the next potential risk window when the next budget season begins. I think with the presidential election less than a year away at that point, it's fair to assume that, cooperation in parliament will be minimal. But again, I think markets have learned that some kind of budget tends to be eventually passed in France, even if the government falls in the process, as we saw in 2024. I would say perhaps this is the kind of next obvious, risk window, but not necessarily one where we'll see political risk actually materializing. We might have to wait a bit closer to the French presidential election, so in May, June next year, to see true political risk developing, I would say. And again, one point that I think is key here is that if you look at the true tail risk scenario, in France, it would be a populist president with a working majority in parliament and a strong Eurosceptic agenda. And this is not our base case. And there is no evidence, I think, that the far-right party will campaign on EU themes either, or that it will be at least, a very strong theme for them. So in short, I would say that OATs for now should remain a carry story, not a political one. The near-term outlook is stable, I would think. We don't have, identify a risk of, say, downgrades from rating agencies, at least in the short term, I think. So no really immediate trigger for a widening, I would say. So we'll keep perhaps the upturn as a more, natural timing for potentially politics or political risk to resurface, I would say. I think another interesting development in France, perhaps, was this week we've learned that the governor of the Banque de France, François Villeroy de Galhau, will step down early. So in June this year instead of October 2027. The official line here is personal reasons, but there's been, speculation that this move gives President Macron the chance to appoint his successor before the 2027 presidential race. And I think also interesting in the context that there was a news from the Financial Times this week that Christine Lagarde could potentially leave her role at the ECB earlier than planned. Interesting kind of like sequencing of news, I would say. But just to be clear, I don't see any real market implications from any of this. Nor do I think it calls, the ECB's independence into question. I think, unlike the debate we're seeing in the US, where political pressure on the Fed, has become part of the public conversation, the ECB operates under a very different legal framework. Its independence is written directly into EU law. And it generally sets its own strategy, defines its own mandate for price stability, and so on. So I think quite important here to make the point that the implication for markets or for ECB independence should be very limited in my view.
Yeah, that is interesting. And I think that last point you made really is just, the key one. There's such a dichotomy between, the next leadership of the ECB and the focus here on the Fed and the nominee Kevin Warsh. But we could perhaps do, a whole nother episode on that. But I guess I'll just pick it up from here and share some of the themes we've been watching. I think the focus with respect to treasuries really has been the pretty steady rally that we've seen over the last couple of weeks. I know it's lost a little bit of steam here to start the week, but we're still at the lows in treasury yields since November. So a couple months since we've been at these levels, particularly in the 10-year. And I'm just looking at a couple things. I know there's been a risk off in equity markets. There's been a pullback in some of these quote unquote debasement trades. We've seen pullback in gold, and that could be driving some of the flows into duration. The curve here has flattened pretty meaningfully, especially in 2s, 10s, less so in 5s, 30s, but certainly in 2s, 10s. And as I mentioned last time, we really saw this type of treasury strength was back in November when stocks were then again going through a bit of digestion. I think they pulled back near 10% October to mid-November, and for pretty similar reasons, actually. AI concerns. I know more recently the concerns have, edged on the side of AI disrupting other industries, software, transportation, logistics, the likes of that. But nonetheless, AI concerns broadly. And the more recent, I think, pullback seems to have a little bit more staying power than what we've seen previously. So we'll see with respect to that risk off theme. The other thing that is going on here, the U.S. is amassing pretty much an armada off the coast of Iran at the moment. There's been slow, at least in my view, progress on any U.S.-Iran nuclear negotiations that may be taking place. And truthfully, it's not wholly clear where the middle ground of these type of negotiations might be. Is it nuclear development? Is it ballistic missiles? It could be the works. So I tend to feel that if you're, President Trump and you're the U.S., you don't necessarily put that many assets, be it warships and airplanes and otherwise, in one location, really unless you plan to use them. And the market could feel that way too, especially after what we saw in Venezuela back in January. And if we're just looking at oil prices, which I think is a pretty good metric to use here for these risks, oil prices are up 15% this year on some of these risks. So if I'm just thinking about some of the Treasury strength we've seen here recently, I think these two things, pullback in stocks and the risks in Iran, could be driving some of the rotation. One of the topics we've discussed a few times, multiple times, I should say, over the last year, has been the pension rebalancing story, just how overallocated pensions are to equities. And some of these periods of stock indigestion, we think, post an opportunity for them to rebalance more into fixed income. So, that's what we're looking at. But I guess as far as the data goes, not much change in theme that we're seeing. And we're really just not seeing much weakness in the data. The jobs report, as we discussed in last week's podcast, was very strong. We had durable goods orders this week. That was strong as well. Same with industrial production. That was a beat. So really, all signs here, I shouldn't say all, but I should say many signs here suggest pretty robust growth in the U.S. over the fourth quarter. And GDP estimates are tracking closer to 4% than they are to 3%. I'll also mention CPI. Paul got into the CPI a bit in the UK. I'll mention in the US, it was better than expected, but the focus here, I think, was on that headline number when it really should have been on the underlying figures. Particularly, we saw some strength in both core services and core goods. That was moderated by just a select few categories. If you ask our econ team here, they'll actually tell you that they see some pretty robust pass through from CPI and their expectations from PPI next week into the Fed's preferred inflation target, which of course is core PCE, and we think we could see core PCE in January actually edge back up to above 3%. So yeah, I'll also, I guess, mention the Fed minutes that we had this week. These also lean on the hawkish side, at least in my view, despite not breaking too much ground. They really did just solidify the story that there's a higher bar now amongst the committee to ease again. The decision to hold in January, definitely very consensus. But I thought what stood out to me was that there were also several members who would have supported a change in guidance that could have suggested the Fed's next move to be balanced. So, in other words, guidance that could have suggested, a hike could come next, just at the same point that a cut could. Powell sort of leaned against that in the presser. He said a hike wasn't in anyone's base case, but just nonetheless, I think the mention of that change in guidance in the minutes itself is a pretty hawkish progression, especially when you're looking at what we have priced into markets right now in terms of Fed easing, which is over 2 cuts. So if we're thinking about the Kevin Warsh story that I briefly mentioned, I think the minutes also made it clear that when he does take over for Powell in May, he's got his work cut out for him. He'll probably have a hard time delivering a rate cut, in my view, if the status quo maintains. But I think, this is where another piece of the minutes was interesting to me, actually, because it noted that several members expected lower inflation due to productivity gains. So we can hear AI here, and deregulation, which really means Trump's policies of deregulation. So if they're expecting a boost in productivity to help with the inflation story, then I really think this is the story that Warsh needs to grab onto if he wishes to cut in June, as is our expectation. He should be leaning into those on the committee that are already expecting increase in productivity to lower inflation and really use that as the lever to deliver his easing. So I'll be interested over the next couple of months whether we hear that story sort of re-emphasized by existing Fed members as well, and whether he'll also be on the news sort of talking that line before he comes into the seat. By the way, we are still assuming that he ends up in the seat that he is approved by the Supreme Court. Yeah, so those are the broad themes that we're watching. As I said, it's really the notable Treasury strength, particularly amidst some of these hawkish progressions from the minutes and the data. And the larger themes in our eyes remain. We're looking at strong growth. We're looking at still elevated inflation, particularly in some of those subcomponents I mentioned. And we're looking at a pretty resilient labor market, and those three things really haven't changed too much in our eyes. So we're still overweight risk to inflation, overweight the threat of Fed independence, and we're still looking for a steeper Treasury curve. And the last thing I'll mention hasn't happened yet, but we could potentially get a ruling from the Supreme Court tomorrow with respect to Trump's IEEPA tariffs. So just keeping that on the radar. If it doesn't come tomorrow, which would be Friday, there is the chance that it could come early next week as well. And we've talked extensively about our expectations for that ruling. But just to reiterate here, even if these tariffs are struck down, we think that the administration has ample other pathways that they can use and have probably spent the last few months preparing to use in a way that they could potentially just reinstate the existing tariff regime. But nonetheless, a risk point to watch for markets, and we'll be watching closely as well. So let's leave it there for today. Like always, if you enjoyed today's episode, please remember to like and subscribe to Bondcast. Thank you, everybody.